Hello, good morning. Welcome to the Mortgage Rate Forecast with Scott Criss, your mortgage rates and news. It is January 4th, Thursday, and let's get started with the charts. Here's what we have. Checking the 3.5% coupon. We're currently at 102.61 this morning. Support's coming in below us. If you look at my mouse, about 102.20 and 102.40. So we have kind of a pretty big drop here. We're definitely on what I would say are top of our trading levels. Uh, Current resistance is above us at about 102.67 and 102.80 up here. We've had a hard time breaking 102.80. So here's the scoop, guys. Reports came out. The ADP jobs report was hot, way better than expected. And jobless claims, much fewer unemployment filings than expected. So all of these things pointing toward an improved economy. So when you have an improved economy, if you're an investor, a lot of times you're going to take your money out of the safety of bonds and put it into something where you're going to have a little bit better returns, a little bit better growth like stocks. So this could be putting some pressure on bonds. But if you look at the charts, despite these bad reports and the news, how the Dow breached 25,000, bonds are still kind of hanging in there. But I got to tell you, a lot of analysts are really sketchy about tomorrow's jobs report. If it comes in anything close to the ADP and the unemployment claims that we saw today, we could see a pretty big sell-off in the market tomorrow. So to kind of quantify where we're at real quick before we get into the forecast, November bonds averaged right around 102.80. We're currently at about 102.61, not bad, 19 cents worse. So based on Freddie Mac, if the average consumer had a rate of 3.92 and was paying half a point to get there, then they may be paying closer to 0.69 points to get there. So still not too far off from November from where we're at, but I would say be careful now. We could see some sell-off. So here's the forecast. My last projection was a miss. Bonds did beat my expectations, so I guess I'm being a little bit, the sky is falling. But man, still, the analysts are relatively bearish on the market over the short term and the long term pretty consistently. So here's going to be my forecast. I think we're going to probably be between 102.20 to 102.60 through next Thursday. That's about 1 cent to 41 cents worse than we're at right now. So I think this is, and nobody's going to be 100% accurate, but I think this is a good time to lock if you have an opportunity to do that if you're closing here in the next 30 days. So anyway, that's it for now. Love to hear from you. Leave your comments down below. Everything likes to be liked, so does this video. And if it's your first time on the channel, you can click that guy on the left. That'll get you subscribed, and when we upload new content, you'll get a notification. And if the bond market, the charts, things like that didn't really make much sense to you, it's okay. At the top right, you'll see Mortgage Bonds 101. Click that, and it'll teach you the basics that you need to know as a consumer when you're trying to figure out the best time to lock in your interest rate. That's it for now. Happy New Year. Happy 2018, and we'll see you next week. Take care, guys. Bye-bye.